So the big question is this: how do investors like us, who don't have a PhD in finance or millions to start investing, how do we grow our bank accounts to build real savings and retirements, and yet still have the time to do what we really love? That is the question, and this podcast will give you the answer.
Hey guys, Tom, this podcast. I'm excited to talk to you about something that hopefully will never happen, but has been proposed in modern media, and because of that, I am super excited to talk to you about it. So, quick fast. Today, we're going to talk about, a Wall Street tax, a wealth tax, whatever you want to call it. But essentially, it's this idea that the government needs more money, and so to generate that, they should put like a small tax, kind of like the SEC, right? So right now, the SEC they charge a marginal fraction of a penny or a nickel or a dime. I think it's a very small amount of money. Every single trade executed in American financial markets, like I talk about in the book, the SEC, they charge a very small fee for that trade to occur, and that fee goes to obviously funding the SEC. And doesn't matter who you are, doesn't matter what exchange you're out through, you gotta pay that SEC fee, and then of course your broker is going to handle most of that for you, which is pretty freaking cool. I think that like you can have a central government have total control over the financial market to the extent that at the whip of a bill, they can like fundamentally change the way hundreds of thousands and millions of transactions occur every hour. Billions and billions of transactions. I mean, it's just crazy, and it's so cool that like that can actually happen. You have the central power that has control over these financial markets that are the backbone for billions and millions of people. Their savings, their retirements, all dictated by the British of this one central power. I think that's a pretty crazy concept. So with that said, with this proposed new tax on Wall Street, and Wall Street, I think is a freaking insane way to put it, because you gotta understand, on your left, hey, thank you, really appreciate it, have an awesome day. These financial markets are the basis for so many people's lives, and anyone that's investing in assets, anyone that's creating real long-term wealth through asset accumulation with compounding paper assets, and the most powerful financial powerhouse, economic powerhouse, in the world. It's all based on, stocks, bonds, cryptocurrency, stuff like that, and other derivatives of those securities, which, we talk about in the book, like ETFs, mutual funds, all that boring stuff, which is super cool for so many people. That stuff changes lives. It's insane. It's so cool. So when they propose this tax that they should add, an additional maybe like a penny on every single trade, like what you're essentially doing is you're taxing like the average investor. You're taxing the normal guy. Because I'll tell you what, you've got multi-billionaires trading every single day. And that's essentially what these guys, they're targeting really rich people. Because, the whole tax thing, and they should pay more, which totally makes sense. It makes sense, right? When you're looking at, the metrics for how much revenue this new law would generate, this new act, whatever you want to call it, it's very minimal compared to the amount of money that the government, would like to generate, and at least these politicians want to generate in terms of new programs, new guarantees, new federal grants, increased spending. This was actually covered very well in another podcast by Onyx Singhal. He's a really cool entrepreneur. He runs this awesome podcast. It's so cool. It's the Fighting Entrepreneur Podcast. Awesome stuff. And he's talking about this topic, and he just kind of like glanced over kind of quickly, like, hey, these guys were thinking about adding wealth tax, but like, dude, that could change the lives of so many people, because now you have every single normal person just trying to put away that cash, trying to create those investments. And with a lot of modern brokers, you have very minimal commission structures, because essentially you look at broker rebates, a lot of times these brokers are actually getting paid to fulfill your trades rather than you paying like $5 a trade. It's crazy. It's ridiculous. And it's just insane, especially for people that are just starting. You know, that's a super, super high fundamental barrier to entry into finance that a lot of people have a tough time overcoming. Like, dude, I can pay, you know, upwards of 30, 40, 50 bucks a day in trading fees, all because of these centralized brokers charging rates that are just crazy. And that's why you'll see, you know, Fidelity ads all over TV. Like, where do you think that money comes from? Besides the fact that they have a ton of funds, and those funds charge just crazy rates. And some of them are nice, you know, they have 0% funds, but for a vast majority of them, those are, you know, highly compensated funds. Maybe not as much, thank you, for an individual, but like if you look at long-term compounding effects, those fees, I mean, they stack up. Anyway, that's not the point, right? The point is, these guys, they make a ton of money. They make hundreds of millions. I read the reports, and I would really recommend, if you're interested in learning more about the broker that you're thinking about, like read their annual report and see how much money they make. It's at a very personal level, except for a very small portion of education. And honestly, if you need education, just get 9 to noon. Like, that book is literally what, I've looked at the tests that it takes to become a financial advisor. Like, all the FINRA regulations, SEC tests. Series 7 is a huge one for people that are going to work as investment advisors at registered investment advising companies. And these tests are very basic. Like, honestly, if you read on it and you understand it, I mean, you could basically be a financial advisor if you just studied for like a couple of hours. It's crazy. You can look at practice tests online, but it's like, you know, these guys, they go to college, and you don't have to go to college in financial, but they have to go to college I mean, it doesn't matter, right? You just get a degree, and you can test, and then you can become like a financial advisor, which is awesome, because there are so many of these people that are doing amazing jobs at helping people create real savings and retirements that otherwise wouldn't have the financial wherewithal to actually accomplish whatever they're doing. And then these people, their entire job is financial advising, so they do a tremendous job of researching tax strategies, researching the best things for their specific clients. Maybe if those clients don't want to, you know, go out there and just learn it for themselves, which is totally cool, and that works for so many people. But like, that's like, usually, you know, you got to have like a higher net worth, and essentially you're looking at a point where it's like, if you just invested a little bit of time, a little bit of energy, and a very condensed amount of personal development and growth in yourself, like, all of a sudden you've got the exact same knowledge, the exact same power, and it just comes down to experience as a differential. And here's the thing, right? A lot of these guys, they'll be in work for 20 years, but in all reality, they've done the same thing each year for 20 years. Like, they haven't grown, they haven't learned. And that's why trading's so awesome. That's why I just love it, is because there's always constant learning and growth and development of pattern recognition, technical analysis, fundamentals, you name it. You can continually grow and just get better and better at it, which is so cool. And it's not like there aren't really good financial advisors, because there are people out there that crush it. But usually the people that crush it, that produce real results in the marketplace, I mean, those are the people that are starting their hedge fund. They're starting a hedge fund, you know? You do like a 22 split hedge fund, where you get, you know, a ton of bank, and you can get a lot of people that can invest in you, and then you just produce results that are surreal as they outperform the market, because you understand trading techniques, strategies, you know, etc., and you know how to crush it. Once you know how to crush it, you see a lot of these guys. Jim Cramer, really good example. The guy ran a hedge fund for so long, you know? And because of that gave him the positioning in the marketplace to go out and do, you know, he does on TV, which is awesome. Some of his books, really cool. A ton of those book reviews over on YouTube, which is so fun. They're just a joy. I love them. And there's some good long-term technicals to learn. And in some of his books specifically, I check out, you know, you got to be like in investing, but gauge carefully. I did a really cool review on that. I'd recommend check that out if you really like long-term investing, which everybody should, because long-term investing is crucial to growing that wealth. It's crazy. It's so powerful. Paper assets are like the way to put in like a minimal amount of effort and get a complete maximum amount of results out of it. It's so crazy. You know, I was reading 4 Hour Body, and I can't wait to do a review of that. It's really cool. Tim Ferriss, and he opens up a book, and he talks about minimum effective dose. He talks about, and he's got a lot of pretty crazy stuff. Like, there's some things he does that are just so cool. But it's also, you know, a little controversial, which is cool, because you learn about it over time. But some of the things he talks about is like how to get the absolute maximum results with the least possible effort. And he talks about how there were these studies where so many people, they were working, essentially for weeks and weeks and weeks and weeks to get results, multiple hours a day, just to get the same results that a lot of people using some of his methods and some of the things he learned, they were getting those same results in, like 10 minutes of work a day, 2 times a week. And it was just crazy to learn all these awesome ways. It's just really powerful stuff. Changes your mindset and obviously change your body. It's awesome. I've been doing slow carb for 2 weeks now, so where else that goes, it's been really cool. Just to learn about it. It's really cool stuff. So with that said, when I look at this stuff, the financial markets just being the best way to crush it, it's so powerful to see that like happening and occurring, and then using it as leverage in the marketplace to create those real results. So I'm gonna go back to what we were talking about. So with these financial advisors and these centralized firms with this tax, right? These guys are crazy. I'm telling you. So these guys make a whole bunch of money. The point is, centralized brokers and profit out of your account and into the broker's account, which is stupid. I don't like that. That's dumb. Without really necessarily adding any value, they're just facilitating transactions as a in the financial exchange market, which, like, I don't know. I'm going to do a whole lot of work for the rest of my life, at least the next decade, minimum, working to lower that fundamental barrier to entry into finance. So that's something I'm really passionate about. So when they talk about adding like a wealth tax on Wall Street, right, it brings into question these fees that people are paying, because at a very fundamental level, these fees, they stop a whole lot from doing, they stop investing, they stop people from growing. It's a serious issue for people that just want to have access to financial markets. But for a lot of them, it's super difficult because maybe they aren't educated about it, which sucks. And then they don't know about how to consistently profit and play, like you're the house, right? Not the gambler, which is a very powerful concept in investing. Right? It's making the decisions that are going to win, like you're the house, like you win 60% of the time or whatever the percentage, you get it higher and higher. And you use that as a means to just facilitate tremendous growth in whatever you're doing, which is super cool. Anyway, so when they talk about this tax, where they were going to charge people based, pretty much on their trading, right? You got to think about who is that going to affect, right? If you're looking to target rich, like essentially everyone in America should own assets. Like stocks, just insane. It's so powerful. Right now it's about 50%. Why get to 90%? Because I think that's such an insanely crazy thing. You got to understand, top 1%. Like, why are they the top 1%? Well, let's look at like the number one reason is they own assets that grow their money because they're investors. It's just so powerful. It's really cool. So when I look at this tax, I'm thinking like, this is gonna hurt like everybody. For what purpose, right? You're essentially doing a direct wealth tax on anybody trying to accrue wealth through financial markets, and at the same time, it just hurts everyone. And it's like, it's this market where people are already paying 20-40% in capital gains to pay for their assets of the marketplace. Like, that's insane. That's like a lot of money for a lot of people. And it depends on your income, lower income, lower tax rates, sure, right? It's progressive, okay. But for so many people, myself included, like, if you pay a solid bit of taxes already, based on the profits that you make, instead of trying to facilitate, more trades and then taxing trades and putting fees on trades, which are going to generate a minimal amount of revenue. In fact, if you look at, income from capital gains, once they're realized in the long term, when you have people that are literally cashing out their retirement so they can go and freaking live, these guys are creating insane results already, right? They're already crushing it, which is super cool. And so to think, because like this tax, right? What it would do is it would hinder people from generating wealth. It would hinder them from accumulating assets because it's a tax at the base level of their investments. And like, that is seriously messed up, dude. Because you got to remember, like, when you're starting, the capital that you're working with is super important, and you can use that to generate just a ridiculous amount of long-term wealth through the insane method like compounding, but also active management. It's just cool stuff. So when you look at people that are making so many trades a day because they're trying to go hard, they're going their best and crushing it, those are the same people that would be seriously hurt by some sort of tax. Because for a lot of people, and this is something I talk about in I think chapter 25 of the book. It's called active trader status. It's a tax classification. You go through the courts to get it. And not a lot of people get it because, in general, it's just not very a preferable thing to do compared to starting your own corporate entity, because a corporate entity just has really, 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 really strong tax treatment in financial, in just anything. But there's this thing, and they'll have people, and they go to court a year in advance because they don't want people to lose a whole bunch of money, like in the '08 crash, and then sell their stuff, which is just crazy. Because the bottom, don't sell at the bottom. They don't want a whole bunch of people to lose a bunch of money and go and try to claim active trader status for that time period. Because essentially, when you look at it, what it does is it changes the way that you can expense personal trading expenses as a full-time trader, right? So, or at least seriously significant trading. And I'm talking about more in the book, but the point with it is, hey, it changes the way you expense things, and it also changes the way that you take losses. So you use what's called mark-to-market accounting, and they give you a very, very powerful way to sort of erase losses to an extent, and then use that as a means to go out there and just create these real results in the marketplace, based pretty much exclusively on wiping out gains with losses. Hey, thank you guys so much. I really appreciate it. And I talk more about it in the book, but it's called mark-to-market accounting. That's probably the biggest thing with it, is that it allows you to just have that preferential treatment of losses. So you can deduct more than the typical, right? With capital gains right now, you can deduct $3,000 in losses per year. Now, the goal is not to lose money, right? But sometimes people freak out and they panic or whatever, and financial stuff goes wrong, and they do lose money. And so what they'll do is, well, at least some people, it's very rare, and it's not great for most people. It's a very, very niche subset of people that are working at home, trading every day, 9 to noon, that they'll allow this for. They use that pretty much as a means to allow you to permit more gains, right? So you can deduct pretty much unlimited losses, and use that as fuel to just grow your portfolio whatever speed you want. So that whatever it is that you're doing, you're going to create just a higher level of net worth effects from it, based on the idea that you can deduct more losses. And I talk more about it in the book, but the point with it is to qualify for active trader status, and to be classified as someone like that, you have to go through the court system for pretty much everyone, and justify why you are an active trader. And for most people, that means that basically they're trading 9 to noon. If you're not trading 9 to noon consistently, pretty much every market day, very, very close to that, then you're basically gonna get cut off. They don't let you have active trader status. So you have these court cases where people are going and they're trying to achieve active trader status, especially in circumstances where maybe they were long-term investors. Hey, man, and it just didn't make sense for them to have it. And so in these court cases, they have the court defending essentially what it means to trade actively, using that as a retroactive basis for these people's taxes, which has a direct effect on their livelihood, because essentially you're affecting the way that so many people pay capital gains taxes. And this whole argument is around the treatment of capital gains taxes, because for most active traders, you're paying about 40% effective capital gains rate based on short-term capital gains. Unless you do fancy stuff with options, especially with swing trading. Swing trading, you have a whole lot of possibilities to lessen your taxes, and you can do that through getting rid of gains. But more importantly, it's that 60/40 tax that you get with more advanced options, which always they just comes with time. But the point with it is that basically everyone in the financial market, they're paying a boatload in taxes. As a percentage basis, people are paying their taxes, and the government, on the left, thank you, they have tax advantage accounts as a basis for masses and masses of Americans to create real savings and retirements through long-term investments in the American economy, which is assets that are exempt from taxes in the beginning and then for their entire life, or exempt from taxes once you retire. You pay your taxes, so you don't pay any gain taxes. Your retirement account just continues to grow over time, and and you use that as fuel for everything you do. It's super, super powerful. It's really cool stuff. And that's like, I think chapter 17, 18 of the book, it's really cool. And you can use that for so many people just to facilitate the growth of wealth, whatever it is that they're doing. And then they go out there and crush it, which is awesome, right? It's super, super cool. It's so, so fun. So what happens is you'll have the government, and they'll go and they'll say, hey, look, we got to have this revenue, we have to have this structure, whatever it is. And what happens is people will pay taxes, and they keep paying taxes. It's just over and over, people are paying their taxes. So when they say that, people need to pay more tax, especially on Wall Street, it's like, dude, are you serious? Because these are the same people that are out there every single day going hard to get stuff done, and to put like just this very minimal tax on so many people, generate completely minimal revenue, but it'll drastically complicate the financial accounting system and centralized asset markets, and change the way that so many people look at generating their long-term wealth, especially based. I swear I'm not following it. Yeah. Oh my God, this guy has been biking with me for like 5, 6, 10 minutes, and he probably thinks I'm following. It's funny. Oh my God. So I swear, when you look at the way these systems account for things, right? You pay. Everything goes through these centralized clearinghouses. So if you're going to implement a tax on stock trades, it's gonna hurt everyone. It's gonna incentivize people to take their transactions off of, not to incentivize them to take their liquidity, to take their volume away from stock markets and more into centralized asset markets through cryptocurrencies, and then also dark pool exchanges where transactions occur in the private sector, especially in large pool factors, which is so crazy for so many people, because what it does is it lowers the amount of power that tons of people have in financial markets, and it changes the way that a ton of people transact based on their size. And I don't know exactly how they want to implement it. There's so much crap around this because it's crazy, right? And people are thinking, if they want to do it on a per share basis, per trade basis, like whatever it is, what you're essentially doing is, if I wanted to buy a stock for $10 and I wanted to sell the stock, 3 months later for $20, like there's a very marginal percentage of that. It goes to the SEC right now, centralized markets. And then if I'm trading with a broker that has commissions or spread options or different, or payment for order flows, you might pay a little bit to them. And now what they want to do is just have an additional payment come out of those gains on the entry and the exit, an additional commission. And that commission would be not for regulations, not for a better trading environment, not for anything of value, the individual investor or the individual family, whatever, whoever's investing. But instead, it would just be a tax to pay the government after the fact that $10 gain, probably in a 3-month trade, $4 of that trade is going to go to the government anyway. In most circumstances, in non-tax advantaged accounts, in an individual structure, not based off of a corporate entity. And even if you have it based off a corporate entity, which these hedge funds, investment funds, that's what they do. They still have to pay pretty good taxes, right? Because you think about what they're deducting, which is tons of them. You have a company, you deduct crap so that you pay, less taxes, right? You deduct expenses for operating a business, all necessary and proper expenses, and those necessary and proper expenses, they just come over the course of business, whatever it is. If you have this massive office building, that's a pretty necessary expense if you have 100,000 people trading for you, which isn't the case most of the time. It's different. Corporate tax is a little different. The point with it is that these are companies that are essentially working for you, for investors in the American economy to generate wealth. And you can take advantage of that by using their services. And they, if they're really big, then they're probably crushing it for a ton of people, and that's really, really powerful. You just got to do your research on those things. It's so different, and it's also a whole other level of delegation where you're essentially giving control, just like with a financial advisor, you're handing over to a hedge fund. And so past performance is big without necessarily, past performance isn't necessarily indicative of future results. You just have to be careful and know what the heck you're doing. Which is why for a lot of investments, which I think is total bogus, right? But you have to be a quote accredited investor, quote, which means you have to have a whole bunch of things. And it changes, how much money you have how much you have to be worth, or your income. One of those depends. $1 grand for a massive experience. reduced circumstances. So when you look at that, you look at the way that those people are separated right now from most people in centralized asset markets, right? They are, you basically, you're screwed, right? You just can't, in most circumstances, do that. And so because of that, it creates this environment where essentially the taxes, and they do huge order sizes, bulk transactions, and a lot of times dark pools, but it just depends on centralized liquidity and also the transparency they want for the transaction. Given these lights on, these lights are totally on. Okay, cool. Given the size of the order and the impact that they think it would have on public perception, since for a lot of these huge firms, like, they can't really trade 9 to noon just because the volume isn't there to transact hundreds and hundreds of millions of dollars on a stock that has a market cap of like 20 million and a float of 18. It just doesn't happen. And so that's why, as an individual investor, you're so radically empowered to create whatever outperforming results that you want, because you have access to a section of the marketplace that these huge firms, these big Wall Street players, most of them on a firm by firm basis don't have access to 9 to noon stocks. It's just not feasible for them. And instead they look for lower percentage returns in bigger names. And so because of that, they leave out these small names that are making 10 times the return just because it's harder for them to have access to those markets. So as an individual, you have a tremendous ability to just crush it with 9 to noon stocks. And it's something that's very unique to people, right? Rather than these massive companies. So with that said, those percent returns are great, but you got to put the work in, you got to get it done. When you get it done, you're going to crush it, which is awesome. I mean, it's so much fun. It's just amazing. But at the same time, right, with this wealth tax, you're essentially looking at hurting every single person that's trying to get into finance. Every single person that's trying to start their own portfolio, that's trying to start generating that wealth for themselves and their family and their future. I mean, you're basic, like right now, right? There's a thing in the tax code, and I talk about it in like chapter 8, I think. It's called the Saver's Tax Credit. And the government will give you a tax credit. I think it's up to like $2,500 to $4,000 right now. It depends on if you're married or if you're single. Check the book, check 9 to noon for the accurate number there. But it's a sizable amount. It's a couple grand, right? And if you invest that much money into the American economy, into your portfolio, into your future through stocks or other paper assets, they'll literally give you that amount as a deductible from your tax. Like, the amount of tax you owe will decrease by that much money. They're at certain income levels, right? So they're incentivizing people that don't have money to buy assets that will make them money. I mean, guys, it's like they want you to get rich. These financial markets are created for you to get rich. It's so crazy. And then people are like, oh no, but these big firms, they just want to take fees from us. Like, you can invest in your own portfolio, pay very minimal commissions. And if you have the education to build that portfolio, you're paying nothing. It doesn't cost you anything. These stocks will actually pay you hard cash dividends. Cash. They'll give you cash in your pocket just for owning their stock. And you guys are very lucky. Today, I apparently locked myself out, which means I get to go downstairs using the one and only massive stairwell. So you're going to get an extra couple of minutes of bonus content here, which is super fun. So here, guess this, right? These guys, they're changing the way that people look at their investments in themselves. They're changing the way that so many people, because you got to understand, like, if you're on the street and you hear in the news that the government is taxing people that are buying stocks, the government is taxing you when you sell your stock, the government is fundamentally shifting the way that they monetize the centralized American economy financial market. Like, do you think that's going to hurt or help people to create real savings and retirements through literally the most powerful, proven financial marketplace in history, right? Like, if you can get more people, and they are showing through these incentives that they want people to become wealthy, because if you make freaking $1 million in stocks over the next couple of decades, like, if you can make a ton of money for yourself, the government is going to get paid. They're going to get money, whether you're in a traditional investing account and you're paying as you go, or maybe you're in a tax deferred, like an IRA, and you're going to pay when you make a whole bunch of money at the end, or just once you reach a savings or a retirement goal, whatever it is that you want, even a mini retirement, whatever it is. Like, they're going to get paid minimum. It's like pretty much 20% as long as you have an income, right? And they incentivize you with lower tax rates. For low income people, for low income brackets, right? You can get down to 0%. But for most people, those long-term rates, they're right about 20%, a little bit less, maybe if you have maybe just a low income. But for most people, like, they're getting paid for a vast, they're making so much money. Hey, awesome in their financial markets, and they're getting money one way or another. What they're looking at right now is some sort of wealth tax, some sort of stock tax. Like, that would fundamentally decrease individual profits and increase that barrier to entry into finance for so many people. And I think it would have a massive negative effect. And it's not like I think like if you look at the news and they're saying they're taxing wealth, they're saying they're taxing stocks, saying taxing investing, like, people are gonna be drawn away from that. If you put a tax on anything, like if I tax a jar of jam from Britain, like 10%, like, they're probably going to decrease American sales one way or another. It's likely going to happen. So it's the same sort of idea when you look at individuals taxing equities, taxing stock trades. Like, that's a fundamental way to draw people away from these amazing investments, these amazing assets that can change, literally fundamentally shift. My entire life changed when I found out about the stock market. Like, this stuff is so powerful. And to think that to generate a couple extra dollars for government programs that don't even exist, and to sacrifice the massive, like you're counting your pennies. How do I unlock this door? You're counting pennies, but stepping over dollars, right? Like these new policies, they're taking just a little, they're squeezing just a little bit more out of the everyday investor, but at a cost of pushing people away from financial markets, stopping people from creating real savings and retirements through these assets, and because of that, decreasing long-term tax benefits from assets, right? From taxes based on capital gains. And if you look, like, to think that as an individual, or what time is it? Okay, any person, right? If you're in this financial market and you're crushing it, the government's going to get paid. People are going to get paid. It's not a question of if there's enough money. There's plenty of money flowing to the government because of the stock market. But it's just, you got to step back and realize that you don't really want to sacrifice long-term economic growth for this very minimal short-term gain of a very small tax on individual investments in the American economy. It's just not the way to look at growing. The U.S. is the world's largest financial market. If independent investors across the globe, they're trading in essentially free financial markets where there isn't a tax on trading. The U.S. is a little different just because of the SEC. It's a very minimal centralized fee, and I think that's something that's a little bit crazy, but that's not the point, right? The point is these guys are trying to add cash, and in so many markets, like, you don't pay in Japan. There's no stock trading tax, because these stock trades are the foundation of an entire economy. It's just ridiculous. So hey guys, please think just a little bit, just a very minimal amount about the crap that these guys are saying, because it's just ridiculous. It's so crazy, and it'll benefit just a very small sector of people for a very limited amount of time. Have this profound negative effect on so many aspects of the individual American's investing experience in the most powerful financial market on this planet. So hey guys, I really hope you enjoyed this. Hope you got some tremendous value out of it. Go out there, invest, and crush it. I'll see you guys later. Thanks so much. Bye.
Want more stock market secrets? If so, go get your free copy of my best-selling book, 9 to Noon. You can get your free copy plus $11,176 of unannounced bonuses it took me years to uncover, completely for free at 9tonoonsecrets.com. Inside 9 to Noon, you'll find the top 38 secrets you can use to double your portfolio every 2 years and make upwards of 10% per trade daily.